What is the relationship between interest rates and gold? Um, so, in order to formulate an answer to this question, we need to look at some economic theory, some monetary theory first. So, when interest rates are rising, you have three things that happen. So firstly, you have increased cost of borrowing. So that is quite an all-encompassing point, because what I'm talking about here is short-term debt, long-term debt. So by short-term debt, I'm talking about credit card debt, for example, and for long-term debt, I'm talking about personal loans, mortgages, things like that, and even the type of borrowing where people borrow money to invest in the stock market or real estate. So if the cost of these debts, if the cost of borrowing increases, you naturally get reduced investment. So take for example with mortgages. So with mortgages, if mortgages are costlier, less people are going to take them, and as a result of that, the demand for houses will fall, and eventually you'll have the price of houses fall as well. And for the stock market, you're gonna have less people borrowing money to invest in the stock market. So over time, you'll get less and less people investing in the stock market, and therefore the stock market will start to fall. At the same time, it's important to remember that all of the firms in the stock markets, could be FTSE, could be Nasdaq, could be Dow Jones, doesn't matter. All of these firms, they have debt, some kind of debt. They've taken some kind of loans, and so if interest rates are going up, those firms which have loans, their interest payments for these loans are going to increase as well. So they'll have less money for expanding production, for example. They'll have to lay off some staff because they might not be able to afford paying some people's wages. So it has a lot of negative effects on the economy, and so you'll obviously get low economic growth as a result of reduced investment. Increased cost of borrowing also affects consumption, so it reduces consumption. This sort of ties back to short-term debt such as credit cards. So every time a household uses a credit card, they'll actually end up paying more for the goods and services they bought with it. So that's going to affect households' finances. It's going to they will have to tighten their budgets. Their savings are going to be affected for sure, and that's obviously going to affect their financial health, financial resilience against crises. It can even affect their solvency position if you're talking about balance sheets and things like that. So again, another very negative effect on the economy. Now I separated house prices from reduced invested on purpose here. Now the reason for that is because for most households, if we look at their balance sheets, you'll see that their house is their biggest investment, is their biggest asset in the balance sheet, is the most valuable one. And so if the price of the home that they're living in, that they're paying the mortgage for, is decreasing, well, that worsens their gearing ratio, that worsens their net worth. And if their net worth worsens, then it is absolutely certain that they are going to have a lot of solvency issues. They're not going to be able to, or they will have a very difficult time paying off all of their debt obligations that they've got. So you might even have some households in the economy which have negative net worth. So it's a really serious issue. So combination of all of these things is going to lead to low economic growth. Now, secondly, increased or higher interest rates will translate into increased rate of return on savings accounts in banks, for example. So that's in my opinion a good thing for the economy. Like, people will just put some money away in a savings account and they'll be rewarded handsomely for their saving efforts. So overall, in this scenario, households are incentivized to save, but they're actually indirectly incentivized to reduce their consumption. Now, the reason for this is pretty simple. So let's imagine a household manages to earn £100 extra for 1 month. Doesn't matter if it's like income from their employment or outside of employment. So they got £100 more. Now, is this household going to spend that £100 on leisure? Are they going to spend it on something else? Or is this household going to put this £100 into a savings account and basically have that savings, have that £100 grow into £200 in 1 month or 2 months? So, well, the choice is pretty simple. It is much more rewarding for households to put their money in a savings account when interest rates are high and defer consumption from now into the future. So unfortunately, as a result of increased saving, which is a good thing, you have reduced consumption in the economy. So households are actually going to spend less money on goods and services, and that will translate into lower demand for goods and services in the economy, in the whole economy, in the aggregate, and that will lead to lower prices. So you're gonna have, so not only do you have asset price deflation because of reduced investment, you're also going to have deflation in the price of goods and services, which will lead to lower inflation in the economy, or deflation. And then the third point, you'll have increased capital inflows into an economy that, like in an imaginary country, let's say. I'm going to frame it like that. I don't want to use specific countries. This is just generic model. So what do I mean by increased capital inflows? So increased or higher interest rates, that basically means that savings in a given country, savings accounts in a given country are going to be higher. And so if you imagine a country A and country B, let's say in country A, the savings accounts, they're offering a savings rate of 1%, and in country B they're offering a savings rate of 3%. So obviously, as an international investor, you have an incentive there, you have a signal there basically telling you that you need to move your money out of country A to country B, because you'll get more value for money if your money was parked in country B, in a bank in a country B, because you have a better savings rate. You're basically making 3 times more than country A. So knowing that fact, that will mean that you'll have a outflow of currency out of country A, and it will go to country B. So the currency has been exchanged from country A's currency to country B's currency, and so as a result, the demand for country B's currency is going to increase, and that's obviously going to appreciate the value of that currency, simply because there is more demand for it. There's more people parking their money in country B. So that also is going to lower inflation. That is also deflationary, because if the value of the currency of country B has appreciated so much, it has gained so much value, so much strength, that means you can spend less money to buy more things, and everything is going to be cheaper for the citizens in that country. So overall, there is a small problem here, because we are getting mixed signals. So normally low economic growth, or when things in the economy are going bad, gold price increases, and when inflation is non-existent or decreasing, then gold prices decrease as well, because, well, a lot of people talk about, gold being a hedge against inflation. So if there is no inflation, there is no need to hedge against anything. So that should cause the prices of gold to decrease. But we need something more. We need to dig a little further to see the actual relationship, to see if there is something else going on. I will get to that point a little bit later on. So if we look down, we have the effects of lower interest rates, which is basically the opposite of everything that I mentioned thus far. So you have lower cost of borrowing. That means that the stock market and real estate is going to boom, and that boom is going to create high economic growth, more employment opportunities, businesses growing, etc., etc. you'll have increased consumption because credit cards are they don't sting as much. So you'll have people spending more money on goods and services. So you also have, obviously, as I mentioned before, you'll have a boom in house prices. But again, I want to relate it to the balance sheet of households, of all households, which is that their net worth of everybody is going to increase because the price of their home has increased, which is often their biggest, most valuable asset in the balance sheet in the first place. So all of these are really good. They all create high economic growth, of course. Essentially, you have a situation where you have asset price inflation, and you also have inflation of goods and services as well. So the CPI, the Consumer Price Index, it will increase because of these factors. So that's the first thing, lower cost of borrowing. The second thing is lower rate of return on savings. So savings accounts essentially become useless. So you have, that creates a situation where increasingly people start to park their money into more risky assets, so such as the stock market, as we've seen for more than a decade now. As interest rates have decreased, the stock market has ballooned out of control, as expected, because people are chasing a return. People are chasing some kind of positive yield, which they are not able to get from savings accounts. Lower rate on return. So you get increased consumption, as I mentioned before. But the most important thing here, ultimately, is higher inflation. So, because obviously the combination of the first point and the second point leads to asset price inflation and increase in CPI. So it's a weird scenario where there's high inflation but at the same time high economic growth. So that's the conundrum that's happening there. So the third point is decreased capital outflows. So that is the opposite of what I mentioned before. So international investors will take their money out and park it in another country where the savings rates are better, savings accounts are better. So that means there's more outflow of capital from the economy. That means the currency of that economy is going to be exchanged into another one, and that's going to depreciate the value of the currency, which again is going to contribute to higher inflation. Okay, so again we get mixed signals, just like the previous example. High economic growth, that should decrease gold prices because everything is going well, so there is no risk, no geopolitical risk, no financial risk really, although that's arguable, because if the economy is booming, then for sure there'll be a bust at some point. It's inevitable. So, but anyways, normally high economic growth equals decrease in gold prices, and higher inflation or increasing inflation causes increase in gold prices normally, because obviously gold is considered to be a hedge against inflation. So if there's a lot of inflation, demand for gold will go up, and so will the price. Again, we need to dig a little bit further to see the actual relationship between gold and interest rates. So I've got a chart that I took from Sunshine Profits. Now it's important to remember here that I'm using real interest rate, not the normal interest rates which are quoted. The quoted interest rates are in nominal values, so that means that they do not take into account inflation, whereas real interest rates, they do take into account inflation, and they give you a more accurate picture of the actual interest rates that is present in the economy. So in red we got the real interest rates, and in yellow we got gold prices. So what we can clearly see here is that there is a negative relationship between interest rates and gold prices. So as interest rates go down, especially into negative territory, so here and here, we see that gold price starts to go up. And when interest rates are increasing, gold prices actually drop here. So interest rates going up, gold price is going down, and vice versa. So that is the true relationship between interest rates and gold. It's negative. When one goes up, the other goes down. Now, the simplest explanation for this, I think, is related to the economic boom and bust cycles, and of course the stock market, the relevance of the stock market in that. You see, when interest rates are so low, so much money is being borrowed and being pumped into assets, especially the stock market. So the stock market and real estate, but especially the stock market. You have that creates such an enormous bubble in those respective markets that eventually you end up with a really painful bust later on. And essentially this bust is what creates, volatility, nervousness, just negative feelings in markets. So fear, of course, is part of that. So the bust worsens the economic situation of a country, and that boosts the price of gold, boosts demand for it. Over time, when things stabilize, when interest rates go up, then the demand for gold diminishes, and you get more demand for other assets. It might be savings accounts, might be bonds, and normally money flows out of stock markets as interest rates go up, simply because all the firms in the stock market, they have debt themselves, and that's going to eat their profits, and it's going to affect their performance, of course. So that's my general idea of it. Real interest rates, when they go negative, people are incentivized to borrow. They borrow more, they invest more, economy booms. After a while the economy busts, and then the demand for gold goes up, and then the price of it follows. It also goes up. And so that's essentially what the relationship between real interest rates and gold prices are.